Stay ahead of the game with our weekly economic insights, where we break down the latest financial news in a clear and easy to understand way. Hi, I am Soumya. In today's video, we'll discuss the latest domestic and international economic developments to equip you with the right knowledge you need to make better financial decisions. Let's start with the market indices. Indian indices. Indian equity benchmarks had a turbulent week under the intense selling pressure for 4 consecutive sessions. The Nifty 50 and Sensex opened on Monday at 22,677 and 73,315.1 respectively, but kept sliding lower. However, Friday brought some respite as market made a partial recovery on the positive global cues. Nifty managed to close at 22,149, up 153 points from the previous day. Sensex ended at 73,088, recouping 599 points in the session. US markets declined as geopolitical worries escalating. Tech-heavy Nasdaq tumbled from 16,276 on April 15th to 15,601 on April 18th. While the Dow Jones opened at 38,075 on April 15th and closed at 37,775.38 on April 18th. Commodity market. Safe haven demand drove precious metals higher. Gold opened at $2,369.4 on April 15th and closed at $2,396 at 3:30 p.m. on April 19th. Similarly, silver opened at $28 and closed at $28.335 on April 19th. The oil market experienced a sudden spike. Brent crude jumped $3 to $90.14 per barrel. WTI crude surged $3 to $85.76 per barrel. This surge was triggered by unconfirmed report on social media platforms about explosion occurring in Iran, sparking concerns over political disruptions to the Middle East oil supply. Moving on to the new IRDAI rules for your health insurance claims. The Insurance Regulatory and Development Authority of India has introduced some changes for health insurance policyholders. First, the waiting period for the pre-existing conditions like diabetes or hypertension has been reduced from 4 years to 3 years. This means you'll have to wait 1 year less for your declared pre-existing conditions to be covered by the insurer. Secondly, and most importantly, insurers cannot reject claims citing non-disclosure of pre-existing conditions after 5 years of continuous coverage. Previously, this period was 8 years. So if you have paid a premium for 5 years, your claim cannot be rejected on the grounds of non-disclosure unless the insurer can prove fraud. These changes, effective from 1st April 2024, will relieve many policyholders who often face claims rejection due to non-disclosure of pre-existing conditions. Let's move on to the RBI's new big step for retail loan borrowers. From October 1st, 2024, retail loan borrowers will have a better understanding of their loan's true cost. The RBI has directed banks and non-banking financial companies to provide a key fact statement to borrowers. This statement will include annualized percentage rate, which is the total cost of the loan, including interest rate and all other charges like processing fees, insurance charges, and more. Borrowers will also have a validity period of at least 3 working days for loans with a tenure of 7 days or more to agree to the terms mentioned in the statement. This move by RBI aims to enhance transparency and empower borrowers to make informed decisions while taking loans. Let's shift gears and talk about the recent rally in silver prices. Silver has crossed its previous all-time high and touched around 86,000 rupees per kg. Some analysts believe it could soon reach 1 to 1.25 lakh rupees per kg. Silver also has industrial uses, unlike gold, which is primarily a precious metal. This means its prices are influenced by both economic growth and its role as a safe haven asset. Currently, the gold-silver ratio, which compares the prices of gold and silver, stands at around 83:84. Historically, this ratio has crossed 80 only a few times. indicating that silver is currently undervalued compared to gold. While precious metals like gold and silver can act as portfolio diversifier, most experts recommend allocating a higher weight to gold, around 6 to 7% of your portfolio, and smaller portions, say 3 to 4% to silver. However, if you're a strong believer in silver potential, you can bet on investing in silver ETFs or physical silver. However, be mindful of the risk and volatility associated with the metals. Let's see how liquid your mutual funds are. The mutual funds industry has released the second round of stress test results for small cap and mid cap funds. These results are being closely watched, especially after small cap funds saw their first outflow in 30 months back in March. In the first round, mid cap funds liquidated half their portfolios in an average of 6 days, while small cap fund needed around 14 days. Let's see how the numbers have changed this time. As per the latest data, small cap funds would need an average of 13.7 days to liquidate 50% of the portfolio, which is only a marginal improvement from the previous 14 days. While the overall liquidity stance is largely similar, there are some notable changes at the scheme level. For instance, Tata Small Cap Fund, which earlier needed a whopping 35 days to sell half its portfolio, has improved significantly and now requires only 29 days. On the other hand, giants like Nippon India Small Cap Fund and HDFC Small Cap Fund would now take 2 extra days to achieve the same liquidation targets. Moving to the mid-cap space. The average time required to liquidate 50% of the portfolio has remained almost unchanged at 6.5 days compared to 6.6 days earlier. Interestingly, while most large mid-cap funds like HDFC Mid-Cap Opportunities Fund and Kotak Emerging Equity Fund saw a marginal increase in liquidation days, some smaller schemes like Axis Mid-Cap Fund and SBI Magnum Mid-Cap Fund managed to improve their liquidity positions. What do these results mean for investors? These stress test results give investors a glimpse into the liquidity risk associated with their mutual fund investments, especially in the volatile small cap and mid cap segments. Now let's see what World Bank is brewing with SBI. To support India's green energy transition, the World Bank plans to provide $1 billion line of credit to State Bank of India. This credit line will be used to expand battery energy storage system and electric mobility in the country. The funding aims to attract early investment, mobilize private capital, and promote the adoption of clean energy sources like solar and wind. Let's see whether Made in India chips could be a power source to Apple's iPhones. Micron Technology, the memory and storage giant, is considering a groundbreaking move, supplying chips made in India from its upcoming Gujarat plant to Apple. If this deal materializes, it could be a game changer for both companies. For Apple, it would significantly increase the value addition of its iconic iPhones within India, which currently stands around 12%. On the other hand, it would be a massive boost for India's ambitions to become global phone manufacturing hub. Imagine components powering the world's most popular smartphone being made right here in our country. Let us discuss why FPIs are bearish on Indian market. Surprisingly, foreign portfolio investors in Indian markets seems to have hit the panic button overnight. By Thursday's market close, they had raised their cumulative net bearish bets on Nifty and Bank Nifty futures by a staggering 71,095 contracts, totaling 107,486 contracts. This drastic move likely stems from heightened caution amid rising tension in West Asia and recent amendments to the Indian-Mauritius tax treaty. Let us look at the India's bond market's all-time high. The Indian corporate bond market has just shattered records. In the financial year 2023-24, a whopping 9,97,804 crore rupees, or approximately $1.2 trillion, were mobilized through private placements. That's a massive 17% increase compared to the previous year, according to the data from primedatabase.com. This surge in bond issuance comes despite recent tax changes impacting debt mutual funds and expectations of lower borrowing costs in the future. That's it for today. In this week's Economic Insights, we learned about many big changes and plans happening across different sectors. Amidst all these changes, one thing remains the same: the financial world continues to evolve rapidly.